Good afternoon, everybody. My name is Mike Hastings, and on behalf of my colleague Tim Ash, who's here with us today, as well as Darren, Eddie, Leslie, Andrew, and the rest of the Farwell Wealth Management team, it's my pleasure to welcome you to today's conference call. Today's call is part 2 of 2 in our series on asset class diversification, and we'll be taking a look at real estate investment trusts, or REITs, as they're more commonly referred to. We'd like to thank you for taking time out of your busy day to join us, and we're sure you'll find this call to be interesting and informative. We're very privileged to be joined today by Mario Saric of Scotia Capital. Mario is a director and member of Scotia Capital's real estate and REIT global research team, where he personally covers about 15 of the most actively followed and traded REITs on the TSX. Mario is the holder of the prestigious Chartered Accountant and Chartered Financial Analyst designations, and his research and analysis of REITs is regarded as some of the best in the industry. For today's call, Mario will be discussing some of the finer points about how REITs work, why REITs have performed so well in this economic environment, and he will be giving us his thoughts about what the near future may hold for the Canadian real estate market. Toward the end of the call, we will be having a short Q&A period with Mario, and as usual, we will be accepting questions via email. Should you wish to send us a question, please send it to farwellwealthmanagement@ScotiaMcLeod.com, and we'll do our best to get to as many as we can. Should we not be able to address your question during the call, we will follow up with you privately afterward. So without further ado, it's my pleasure to hand things over to you, Mario.
Great. Thank you, Michael. I'm very happy to be here today. So as Michael mentioned, I'll briefly talk about REITs, how they function, maybe a bit on the history, why you should or shouldn't own REITs in today's macroeconomic environment, a bit on the outlook for real estate, both in Canada and the U.S., and then maybe 3 or 4 top picks at the end of the session. So as far as REITs and how they function, today we have about 30 REITs or REOCs. REOCs would be real estate operating companies on the TSX. The market cap is about $55 billion. When we compare that to the year 2000, back then we had 14 REITs and $20 billion in market capitalization. So the sector has grown significantly in the last 10 years as general appetite for yield has enhanced in this environment, given where bond yields have gone in the last 10 or 15 years. The REITs do form part of the financial subgroup on the TSX. They comprise about 3 to 5% of the composite. That includes both Brookfield Office Properties, or BPO, and BAM, which are excluded from the market capitalization figures that I gave you up above. So interestingly enough, they make up 3 to 5% of the index in Canada. Canadian REITs as a percentage of the global REIT market also make up anywhere between 3 to 5% of the global index. So while we focus on them quite a bit here in Canada, they're still a relatively small player within the global scheme of things, but we think that'll change on the margin going forward. The sector has done very well the last 10 years or so, in part because of a declining bond yield environment. So one thing that we look at Scotia is not just total returns or excess returns, but we also pay close attention to Sharpe ratios, or risk-adjusted returns. And on that front, the REIT sector has done very well, both relative to the TSX and also relative to their global peers. So the sector has definitely gained a significant amount of legitimacy in the last 5-10 years. It did underperform the TSX composite back in 07 and 08 by about 21%, and since that it's outperformed by about 70% over the last 3.5 years, returning an average 29% total return over that time period, predominantly because, in our view, we've seen good operating results, but we've also seen some pretty material bond yield compression. So the question really, one of the questions that we get at this point of the cycle is what happened in 07 and 08 that may result in the REITs underperforming again. And what we saw back in 07 as well as 08 is really, we saw a lot of M&A activity within the space in late 06, early 07. That really drove fund flows to the asset class. Historically, we found fund flows have driven unit prices as opposed to fundamentals. So looking forward, when you're thinking about valuation for the space, it's very important to think about what may drive funds either into the sector or out of the sector. And then secondly, we also saw credit spreads increase dramatically through 07 and into 08. So real estate is a levered sector, so paying attention to credit or availability of credit as well as credit spreads is important going forward. As far as the history of the space has seen a lot of positive structural change within the space. So back in '04, we saw the removal of limited liability from the Board of Trustees. In '05, the sector was included in the index. In '06, we had the SIF legislation, the Halloween treat that came from Minister Flaherty back in October of '06 that essentially grandfathered the REITs from income trust legislation. And then more recently, we also have now the proposed elimination of the S&P TSX equity-only index for benchmarking purposes. That we believe will result in several larger investors out there having to essentially being forced to buy REITs as they transition their benchmarks to the TSX composite. And we anticipate that will happen over the remainder of this year. So the structure of a REIT, essentially it's a very liquid way, or very liquid and passive way to own commercial real estate. So you can own it either through the REITs or you can own it directly. Generally, pension funds in Canada tend to own the asset class directly as opposed to through REITs. So very roughly about 80% of the real estate in Canada is held directly, with the remainder 20% held in public hands or with the REITs and the REITs that we have on the TSX and the venture exchange. On the margin, we would say that the REITs are becoming more competitive with the private players, i.e. pension funds, endowment funds, and whatnot. A good illustration of that increased competitiveness was the recent acquisition of ScotiaMcLeod by a combination of Dundee REIT and H&R REIT. So they were successful in the process, notwithstanding some pension fund interest on the asset. So we think that is a bit of an inflection point as far as showcasing how far the REITs have come over the last 10 years as far as their competitiveness with private capital. So generally speaking, the REITs are structured as flow-through vehicles, as you may know. So they tend to pay out a majority of their free cash flow in the form of distributions. Technically, they must pay out all of their taxable income, but generally the taxable income is substantially, or cash flow tends to be substantially higher than taxable income. So part of your distribution you receive on a monthly basis is a return of capital, which is taxed advantageously relative to regular income. So the REITs do provide a decent yield, and then on an after-tax basis, if that is of concern to your clients, the benefit is amplified somewhat because return of capital tends to comprise anywhere between 40 to 90% of the monthly distribution. As I mentioned before, the asset class is a levered asset class. So in order for REITs to grow, because they pay out most of their free cash flow in the form of distributions, they tend to require access to the equity markets to acquire assets and grow portfolios going forward. So they're very active on the equity issuance side and have been for the last several years. So bigger picture, when I think of a REIT in a normal environment, and I'd say the last 3 to 4 years have been anything but normal, but if you think about a normal environment, what a REIT should be structured to do is to deliver your distribution yield of, let's say, anywhere between 5 to 6%, and then 2 to 3 or 2 to 4% of capital upside, which represents the cash flow per share growth that the REIT should generally average year over year, about 2 to 3%. And because of that cash flow growth, that is why real estate is often looked at as being a hedge against inflation. So inflation will tend to go up during better economic times. Better economic times tend to mean that the REITs can increase occupancy, increase rent, and therefore increase cash flow. So all is equal in a very normalized environment. From the REIT space, you should be getting anywhere between a 6 to 10% total return going forward. As far as the valuation metrics that we look at within the space, there's really 3 of them that are important to keep track of. The first one is AFFO, which is short form for adjusted funds from operations. The simplest way to think about adjusted funds from operations is really free cash flow. So it's the purest proxy for free cash flow after capital expenditures, after leasing reserves and whatnot. So the REITs tend to trade on a multiple of AFFO, just like regular stocks tend to do on a multiple of PE or EV to EBITDA. The second evaluation measure we look at very closely is implied cap rate, and more specifically implied cap rate spread to the 10-year bond bond yield because it is an interest-sensitive asset class. The easiest way to think about an implied cap rate is essentially it's the inverse of your EV to EBITDA multiple. So the lower the implied cap rate, the generally the more expensive the REIT is perceived to be. And the third measure that we look at is net asset value. So unlike other asset classes, the REITs do have tangible asset value supporting unit prices. Generally, what we've found within the space going back over time is NAV is a good predictor of future equity returns, which is what we care about, but only at the extremes. So for example, if you do want to generate alpha within the REIT space, historically it's paid to buy the sector when it trades at a discount to NAV, and then sell the sector or be underweight the space when it's trading at a significant premium to NAV. And by significant, I would classify that as being anything 20% and above. And today we find ourselves at about a 13 to 14% premium to NAV. So if the sector does come up another 10%, all else equal, that's where we become more cautious on valuation. And conversely, if the sector were to correct by 15% or so, that's where we become much more bullish on valuation for the space going forward. The last point I'd make on valuation before I talk about why you should or shouldn't want to own REITs in this environment is really it's important to look at the absolute valuation, so the absolute multiples, the cap rates, but it's also important to look at those valuation metrics on a spread to the 10-year bond yield. So much like the utilities, the telecoms, these are interest rate sensitive assets, and so the valuation will move in line with where the bond yield goes. And that's one of the reasons why we've seen substantial appreciation in asset values over the past 4 or 5 years, and the sector may look expensive on an absolute AFFO multiple basis, but when we look at the spread to the 10-year bond yield, much like other interest rate sensitive assets that are measured against the 10-year bond yield, we actually look relatively cheap. So our overall call for the space is a 5 to 10% total return over the next 12 months. So effectively, we think that you'll get your distribution yield and plus maybe a couple of percentage points of capital upside from this point forward. We think it's unlikely that you'll see the REIT sector replicate the types of returns that it has achieved over the last 2-3 years, given the prospects for higher rates going forward. And I'll spend some time talking about that in a minute. So the second question I guess this leads to is, should we own REITs in this environment? My answer would be yes. You should own REITs in this environment. We would not be overweight the REITs in your portfolios, nor would we be underweight. So we do have a market weight call within the space. Effectively, very high level, the way to think about REITs and fund flow into the space, which, as I mentioned, is a critical driver of valuation, is things should go well for the space as long as the macro environment doesn't get too good or it doesn't get too bad. So that's a very high level way of thinking about it. In a too good scenario, we see economic recovery really pick up. We see cash flow growth take off in other asset classes. Generally, that would mean higher interest rates going forward, and that would be a situation where we very well may see rotation out of the asset class into asset classes that investors perceive to deliver better growth. So that means higher rates would not necessarily be good for the space going forward. Conversely, we would also argue that if things get too bad, i.e. a relapse into economic recession, that would also not be a good situation for the REITs, because presumably an economic recession would lead to a tightening in credit, similar to what we saw in 07 and particularly in 08. As I mentioned before, the sector is very much a levered asset class, so a tightening in credit or even the perceived tightening in credit would likely have negative ramifications for the space. All else equal, in a steady state environment, modest GDP growth of, let's say, 1 to 3%, continued availability of debt capital is actually quite a conducive environment for continued fund flow into the space. And at Scotia, for example, we're not looking for robust economic growth. The banks seem to be in decent shape from a lending perspective, so we actually think that's a pretty good environment for the REITs, at least over the next 6 to 12 months. As far as inflection points from a valuation standpoint, so one question that we often get is, what are some things that we should look at in order to identify whether it's time to either get into the space or get out of the space? So I spoke about one earlier on with respect to net asset value. So we look at that as being an inflection point. So if your premiums to NAV get extremely high, then that's likely an indication that it may make sense to take profits. Secondly, the other inflection point that we've started looking at the last several years are CMBS spreads, particularly in the U.S., because the CMBS market in Canada is not nearly as developed as it is in the U.S. So one, as I mentioned earlier, some of the underperformance in 07 and 08, we saw CMBS spreads really widen out, and that had a negative impact on REIT valuation both in Canada and the U.S. So we also think it's important to monitor where mortgage debt costs are as well as CMBS spreads in the U.S. going forward. So as I mentioned, we are looking for about a 10% next 12-month total return or so. That is supported by the distribution yield of 5 to 6%, which generally we think is sustainable. So the average AFFO payout ratio in Canada is about 90%. For the sector, historically it's been closer to 100. So we do think that the distributions are safe, and in fact we think that there will be several REITs that will start growing their distributions. We saw an example earlier this week with Brookfield Canada Office Properties increasing the distribution by 8% and still maintaining a payout ratio below 100%. One other positive for the sector going forward is from a growth perspective, we are looking for very good AFFO per unit growth of about 8%. That compares to a historical average of about 3%, so substantially higher than historical average. So one might ask, how is that possible in an environment where the economy is puttering around and we're not seeing very strong macro indicators out there? And the answer to the question is really low debt costs. So of that 8%, we would allocate about a third of that growth to what we call organic NOI, or net operating income growth. That's effectively rents going up or occupancy going up for the most part. A third of that growth comes from the simple notion that because debt costs are extremely low for commercial and apartment REITs today, they're able to refinance expiring debt at much lower rates. So expiring debt is coming in at 4.5% to 5%. The REITs can get 10-year debt today at sub 4% or close to 4% for commercial debt, sub 3% for CMHC insured apartment debt. So as that debt comes due, they're simply able to refinance that debt at lower cost, thereby driving their interest costs lower, especially for REITs that have low AFFO payout ratios. And the third part of the growth is acquisitions. So we are still seeing the REITs active on the acquisition front. One reason why they're able to do so or be so is because of the low debt cost environment. As far as asset preferences within the sector in this environment, we continue to remain a bit defensive. So we like the apartment space from a fundamental perspective. We also like the consumer staple retail space. Those two are generally considered to be the two more defensive asset classes. We also do like the office space as well as the hotel sector, albeit those asset classes tend to be a bit more volatile. I do want to touch on REITs and interest rates because that's probably the most common question that we get and the most common fear that we get from investors with respect to investing within this space. And we've spent a lot of time looking at historical trading patterns and how the REITs will do in both a rising and falling interest rate environment. And so specifically, we've done one study about a year ago where we took a look at how the REITs performed relative to the TSX composite in both a falling and rising interest rate environment. That interest rate that we're referring to is the 10-year bond yield. And going back to 98, on average, when the 10-year bond yield is falling, the REITs tend to deliver an 11% total return, which translates into 11% outperformance versus the TSX composite. So falling rates, which have generally been the case for the past 20 years, have definitely been supportive of REIT sector outperformance. But the more interesting question is on the rising rate environment, because presumably most people feel that rates will go up as opposed to go down. And if I was sitting here with you 12 months ago, I would have said the same thing, and 12 months later, bond yields are lower than they were 12 months ago. So generally speaking, the prospects for rate growth are higher than further deceleration in our view. In a rising rate environment, what has happened has been that the REITs have underperformed the TSX Composite by an average of 7%, but the actual total return the REITs have provided for investors has been plus 8%. So effectively what's happened, even if rates have gone up, the REITs will still deliver a positive return for investors, your distribution yield pretty much, and maybe a little bit of capital upside, but they will significantly underperform the TSX Composite as investors look to asset classes that can theoretically provide more growth than the REIT sector can. So in a nutshell, the space has done well in a falling rate environment. It tends to underperform in a rising rate environment, but it still does deliver positive returns, i.e. your distribution yield plus some capital upside, even in a rising rate environment. And we've identified 10 rising rate environments in the last 13 years, and out of the 10 years, or out of the 10 cycles, the REITs have delivered positive returns in 9 of those 10 years. So the overall message from a rising rate standpoint is you'll likely get better returns elsewhere, although it's still reasonable to expect a positive return coming in from the REIT space. The last point that I'd make on the REITs and the interest rates is we also looked at how they perform relative to the short end of the curve. So there's been questions as to when the Bank of Canada may start tightening at the shorter end of the curve, and we don't have as much data going back on this simply because we haven't seen as many tightening cycles in Canada, but there's been 3 of them that we've identified over the last 13 to 14 years. And generally the REITs hold in from a valuation standpoint or from a performance perspective up until 3 to 6 months after the first rate hike. That is when we start seeing some relative underperformance versus the TSX Composite as well as relative to the TSX Financials subgroup. So at Scotia, our economics team has identified the first rate hike for the Bank of Canada coming in Q3 of 2013. Last month it was Q2 of 2013, so they've pushed it out a quarter, and that's generally been the case, I'd say, for most prognosticators out there. So if we specifically look at the short of the curve, if we don't anticipate a rate hike up until Q2 or Q3 of next year, arguably that provides the REITs with another 12 months of decent returns. So if this was a baseball game, I don't know if any of you are baseball fans, but if it was, we would say that we're in the 8th or 9th inning, or we're probably closer to the 7th inning stretch at this point. So still another 12 months of positive returns in our view going forward. As far as the third question, the Canadian and U.S. real estate outlook, from a fundamental standpoint, we do think the outlook looks pretty decent across asset class. Historically, what hurts real estate valuation is the simultaneous demand destruction and new supply creation. That's really when we see prices depreciate. Generally speaking, there are pockets within Canada and the U.S., but generally speaking, new supply is fairly limited across most asset classes. That is a direct consequence of the economic recession and the credit crisis. So it's been more challenging to obtain construction financing for several asset classes. On the demand side, we are continuing to see decent demand across most asset classes. So we do expect, or we are looking for, as I mentioned, NOI growth or net operating income growth of anywhere between 1 to 4% on average in Canada. Arguably, the U.S. may be looking for a little bit more simply because we saw a greater correction in occupancy and rent during the crisis in the U.S. relative to what we've seen in Canada, which has exhibited more stability. So there was less downside in Canada, and as a result, perhaps less upside from a cash flow perspective in Canada going forward. That demand that I refer to is largely tied to the broader economy. So generally, if we do see accelerating economic growth, we should see increased ability for the REITs to improve occupancy as well as rents going forward. their ability to capitalize on an improving economy is in some way connected or tied to the duration of the lease. So for example, retail and office tend to have longer lease terms, so even if the economy, let's say, is doing very well and rents are rising, your ability to re-rate your rents or adjust your rents is less than it would be for an apartment REIT or for a hotel REIT, which have shorter lease durations. So an apartment REIT has an average lease duration of 1 year. A hotel REIT has an average lease duration of 1 night. So they're very sensitive to fluctuations in the overall economy. One point, or one final point that I'd perhaps make on the real estate outlook in the U.S. versus Canada going forward is just on the residential side. We also do look at the residential market, given I cover that the apartment REITs in Canada, and generally we would highlight the Canadian housing market as being a bit of a risk to real estate fundamentals in Canada going forward. Based on some of the work that we've done, we feel that current home prices are not sustainable based on where disposable income per capita are in the country. So historically, and by historically I mean going back to the last 50, 60 years, there is a pretty tight correlation between disposable income and average home price in Canada. And based on that correlation, or based on the work that we've done, it suggests that home prices in Canada are 15 to 20% overvalued relative to where disposable incomes are. So either we have to see a prolonged period of disposable income growth to catch up to where home prices are, or we potentially may see a bit of a correction in the housing market. As far as playing that through the REIT space, we would argue that the apartment sector, if you are concerned about a housing correction, we would argue the apartment sector probably provides you with the best shelter against potential correction, because individuals can either rent or they can own. So at this point, real estate is very much a local game, but generally speaking, it's very difficult to cover your holding costs on residential real estate through rental at this point. So unless you have expectations for further capital appreciation within the housing market, from purely a financial perspective, it doesn't make a lot of sense in our view to be buying a home in most parts of the country. And it's interesting because I've been saying this for the past 3 years, and so I've been wrong for the past 3 years in the housing market. And on a personal level, where I myself am looking at a home because of a new addition to the family, and so I'll come back every night and show all these charts to my wife as far as the sensibility of renting in today's environment, and she tells me to take those charts and throw them out the window. So there is a psychological aspect of home ownership. However, purely from a financial perspective, in our view, unless you believe further capital appreciation exists, it really doesn't make a lot of sense to be buying a home today. So that would be the outlook for both Canada and the U.S. On the real estate side. So I would like to just end off with 3 or 4 top picks within our space, and I've tried to provide a top pick for each investment strategy, so whether you're looking for risk, defense, balance, or value. So the first pick I would highlight is Brookfield Office Properties, tickers BPO in Canada and in the US. So we have a one sector perform rating, 1925 target, that reflects a 19% expected total return. The yield on the security is about 3.3%. BPO owns a very high quality portfolio of assets throughout the US, Canada, and Australia. It trades at a very significant discount to NAV of about 14% based on our estimation. It also trades at a very wide discount to its large cap US office REIT peers. The question is why? And the answer to that question is that the stock has been under a bit of pressure because it does have a large lease maturing in Lower Manhattan at World Financial Center, about 3.4 million square feet. So the market is uncertain about its ability to renew that lease, which expires in October of 2013. Ultimately, we think the space will get released because we see the World Financial Center being the building as being a cost-effective option for several tenants. It's very well located in the downtown west part of Lower Manhattan. And BPO historically has had a very strong leasing track record. So it may take a little bit of time, but we think ultimately the space will get released. The catalysts for the story, obviously, leasing announcements at the building. So we do think we may start hearing of some in Q4 of this year, post the elections, as tenants gain a bit more visibility on the general direction of the economy in the U.S. going forward. We would highlight a second catalyst for the story would be pension fund reform in Australia. As I mentioned, 20% of the portfolio is in Australia. Cap rates in Australia are particularly high because mortgage costs are very high, because we don't see a lot of bank participation on the lending side. We are seeing some regulatory changes there that could lead to lower cap rates in Australia, which would be positive for BPO. That would be the second main catalyst that we see over the next 12 months. So BPO we would consider a high-quality portfolio, also providing shareholders with value or investors with value today, which is a rare combination within the REIT space. As far as the second top pick, this would be a risk-on type recommendation. It would be Invest REIT, so it's a smaller cap REIT, about $400 million or so. We have a one sector perform rating, $5.50 target, translating to about 15% rate of return, almost an 8% distribution yield. Invest owns Canada's largest hotel portfolio with about 19,000 suites. That would include hotels like Comfort Inns, Deltas, Hiltons, Fairmonts, Holiday Inns. So a pretty decent proxy for the overall Canadian hotel space. It also trades similar to BPO at a large discount to historical valuation to its peers, and at a modest discount to net asset value as well. Part of the discount is the fact that it's cut its distribution 3 times in 2 years. Based on our estimates, we think the distribution at the 40-cent level today is sustainable. So we do think that the 7 or almost 8% yield that you're getting is a safe one. We like the outlook for the asset class, particularly if the economy starts to accelerate, because we have yet to see cash flow growth really take off coming out of the downturn. One of the benefits of the downturn for the hotel sector is that it's been virtually impossible or very difficult to attain construction financing. So the supply of new hotels coming to the market over the next 2-3 years is expected to be quite low. So if we do see a ramp up in demand, which we are anticipating, the positive demand-supply imbalance should lead to higher room rates, which is the key catalyst for investor going forward. And lastly, as I mentioned, with the attractive and sustainable yield, in our view, you're really getting paid to wait for that recovery in the hotel sector to take hold. The third pick that I'd highlight would be Allied Properties. This would be more from a balanced point of view, balance meaning we think it provides good offense as well as defense. So one sector performed 29.50 target, 4.4% yield. You'll notice that the REIT is now actually trading above our target price. So we are heading into Q2 results where we'll adjust or potentially adjust our target prices on some of these names going forward. But really, the reason why we've been promoting Allied has been that it provides defense to investors in the form of a very conservative balance sheet. So the leverage is quite conservative at sub 50% debt to fair value. Allied, as a bit of a background, if you don't know the story, is Canada's largest owner of what we call Class I office space. The I stands for industrial. For our listeners in Toronto, if you think about King Street between Spadina and Bathurst, Allied owns virtually all of those buildings. So the asset class itself, or the Class I office space, demonstrated what I would call remarkable resiliency during the last economic recession. So we do look at it as being somewhat of a defensive office asset class. So those are the two drivers of the defensive argument. The offense really comes from a very interesting what we call intensification pipeline. So Allied currently owns 8 million square feet of this Class I office space, as well as some space that is not quite Class I, but it's relatively close. It has several opportunities in Toronto to build on existing land. So the land is currently zoned for twice the amount of coverage that the current building provides. So there are some opportunities for them to either build beside or on top of existing buildings. Because the cost of the land is already baked in, the types of returns they can get on redevelopment are very attractive. We anticipate Allied will announce their first initiative on that front within the next 4 to 6 weeks. So that pipeline we represent, or we estimate, is about 20 to 25% of their existing GLA. We believe there's no other REIT in Canada that has that type of development upside. in our view. So in a sector that is pretty reasonably valued, we think investors will increasingly migrate towards names that can deliver above average AFFO per unit growth, and we think Ally is well positioned over the next 4 to 5 years, assuming they can get some of these developments off the ground, to deliver exactly that. So that's really the upside to the story in our view at this point in time. It has had a good run. As I mentioned, it does trade at a premium to the space, but we think that premium may likely grow going forward as investors increasingly look for growth. Lastly, on the defense side, REIT, one sector performed, 4150 target, 3.4% yield. This is a REIT that is covered by my colleague, Pami. It's a diversified REIT with a focus on high-quality office, industrial, and retail. It's considered by many to be the most defensive name in the sector, so it also has a very conservative balance sheet or conservative leverage in the low 40% range. Its payout ratio, or AFFO payout ratio, is very low, in the low 70% range. Lower AFFO payout ratios tend to serve as a proxy for distribution growth going forward, so this is a name that has delivered good distribution growth or consistent distribution growth in the past. And from an upside perspective, my colleagues indicated that acquisitions may represent upside for this story going forward. But this is kind of the name that if you want to, as mentioned earlier on, if you want to sleep at night and feel comfortable, it doesn't give you the greatest yield within the space, but it's considered to be one of the more defensive names within the space. So we've provided a pick on the value side, the risk side, the balance side, as well as the defense side. So I'll leave it there, and I'll be happy to take any questions if you have any.
Okay, that's great. Thanks very much for that, Mario. And we do have some questions that have come into us. I think you briefly touched on the first one here, being that could you address whether you think it's better to own commercial real estate or residential real estate at the moment and going forward? I think you said that you'd rather own residential now until you see more economic growth.
Yeah, well, if commercial, there's various components of commercial. There's office, there's industrial, there's retail, and by residential, if the caller or if the listener is referring to apartments, then I would agree. Residential, single-family homes or condominiums, I've mentioned that we're cautious on that front going forward. Generally, our view is that if your fear is higher rates or rising rates going forward, as I mentioned, I think the apartment space provides good shelter against rising rates going forward, because rising rates would presumably make home ownership more challenging or more costly because your mortgage rates go up. And then also, as I mentioned before, because of the apartment's short duration leases, if rates are going up because of economic growth, then presumably the apartments can take better advantage of the better economic growth by increasing rents and increasing occupancy levels at a quicker pace than some of their commercial peers.
Okay, great. Thanks for that, Mario. And next we have, with bond yields at historical lows, would you consider REITs to be a better place to park some of your money than fixed income? I understand that REITs are quite safe at the moment and pay, say, a 6% dividend.
Well, it's a good question. When we look at, so I mentioned it's important to look at the REITs from an implied cap rate standpoint, but also on a spread to the 10-year basis. When we look at the implied cap rate spread for the REIT sector relative to, let's say, long corporate bonds in Canada, that spread is still above historical average. Meaning, arguably, if you believe in mean reversion, then there potentially could be more downside in bonds or fixed income as opposed to REITs, because that spread is wider than historical average. Now, I don't cover fixed income, so it's not my place to recommend a strategy on fixed income, but that's the relationship that we see in the market today between the two. And the other point that I would highlight, unlike fixed income, the REITs do have the capability to deliver some pretty good cash flow per share growth going forward. So you are getting that yield today, which is lower than it's been historically, but to supplement that, we are expecting some meaningful cash flow per share growth, which theoretically you don't get within the bond market.
Okay, super. And our next question would be, and I think you touched on this as well, there's been some recent consolidation in the Canadian REIT universe, namely Canmark and White Rock, which were both acquired at significant premiums. Do you think this trend will continue with the low interest rates we're seeing going forward?
Another good question. I do think that there is the possibility of it continuing. When we look at where REIT prices are today, once again, the implied cap rate spread, so the implied cap rate being the inverse of the EV to EBITDA multiple, so the 10-year bond yield is above where it's been historically. For the sector, it's above where we've seen historical M&A activity take place. And there is this push within the REIT space, I would say, to get bigger. We've done some interesting work on the drivers of individual REIT AFFO multiples over time, and two of the bigger variables that drive your AFFO multiple historically have been market cap as a proxy for liquidity, as well as the AFFO per unit growth. So what the sector has historically said to REITs is we have a difficult time investing in your companies because liquidity is not the greatest relative to other asset classes. So it would be beneficial if you were to grow your liquidity by issuing equity to fund accretive acquisitions. So that notion does support the thought of M&A activity because M&A activity tends to mean that one of the REITs will get bigger, the other one will obviously be privatized, and presumably if that holds true, then the bigger you are, then arguably maybe the better multiple you're get. There's many other factors that go into determining your multiple, but that's one of the big ones. So in scenarios where you do have, let's say, two REITs, one that trades at a substantially higher multiple than the other, and there is some strategic overlap between the portfolios, that does afford the ability for the REIT that's trading at a higher multiple to pay up relative to where the target REIT is trading and still make it accretive to their numbers. And generally, if we go back to the 1990s, the average premium on an M&A within the space has been about 15 to 20%. So that's historically what it's taken in order to privatize REITs within the space. That's an average. So there's been scenarios where it's been less than that, and there's obviously been scenarios where the premiums have been much higher than that. So generally, we don't see a ton of activity going forward, but we do think that there may be another transaction or two down the road, which would be supportive of sector valuation on the whole.
Okay, appreciate that. And I guess, Mario, in the sake of time, we'll ask one last question here, and that would be, would you advocate owning a real estate ETF, or would you prefer owning a couple of select names instead?
Well, the REIT ETF provides the obviously exposure to the space without stock selection. So they'll generally, as you know, mimic the REIT sub-index in the TSX composite. So RioCan, for example, is the largest participant in that sub-index. So it's an easier way of maintaining some exposure to the asset class. In this environment, depending on whether you have the time to do the research, and if you do want to do the research, in this environment, given reasonable valuation pretty much across the board for the REITs, we do think that stock selection will become increasingly important within the asset class. And I harken back to what we mentioned earlier on as far as looking at names that do have perhaps better cash flow per share growth profiles going forward. We think will be names that will do well, because generally a higher cash flow per share will tend to mean better distribution per unit growth, depending on where your existing AFFO payout ratio is. And in a higher or a potentially higher rate environment, we think REITs that can grow their distribution per unit at a better clip should do reasonably well. So short answer, we do think that stock selection is increasingly relevant in this environment.
Thanks, Mario. Obviously, those are excellent points. Looking at the clock, I think we're pretty much out of time, so I think we're going to wrap things up here. I want to say thank you very much to you for taking the time to join us today. Really enjoyed listening to your perspective, and I think it's safe to say we're all going to come away with a much better understanding of REITs after today's call. Also, thank you to those who have dialed in to join us today. We know you're all very busy, so we appreciate you taking the time to join us. We'll leave it there. Have a great day, everyone, and we look forward to having you join us for our next call coming up next month in August. Thanks very much. Bye-bye.
A chairperson has ended this conference. You will now be disconnected.